Let's be honest, chasing those juicy 10% plus dividend yields for 2026? It's a trap, and it's one that could absolutely decimate your portfolio. So many investors are walking right into it, lured by the promise of huge, passive income. That's exactly why I'm ignoring them. I'm focused on building a portfolio for sustainable income that also keeps inflation from eating my lunch. And today, I'm going to show you exactly how I'm doing it. Section 1, the high yield trap. Explain. Everyone wants passive income, right? But the biggest mistake I see people make is blindly chasing the highest dividend yield they can find. Here's the problem: when a stock's dividend yield looks almost too good to be true, it's often because the stock price has been tanking. This is a classic red flag for a yield trap. It's a situation where a company's business is on shaky ground, and it can't actually afford to keep paying out the dividend. They lure you in with a tempting yield, but then, bam, they cut the dividend, and both your income and your initial investment can get crushed. Now, not every high-yield stock is a disaster. Certain investments, like real estate investment trusts, REITs, are designed to pay out most of their income. For instance, an ETF like KBWY currently boasts a massive dividend yield of nearly 10%. But here's the catch: it comes with a ton of volatility and a history of its price decaying over the long run, which makes it a risky foundation for your portfolio. The danger isn't the yield itself, it's chasing that yield without understanding the risks hiding underneath. Section 2, a smarter strategy for 2026. So if we're not just chasing the highest number, what's a better way? My strategy for 2026 is built on a simple philosophy, combining sustainable income, inflation hedging, and long-term growth. Instead of gambling on a single metric, this approach builds a portfolio that's resilient. The 3 ETFs I'm about to share are the engine that drives this entire strategy, giving you a powerful mix of income for today and growth for tomorrow. Section 3, the portfolio engine, 3 core ETFs. First up, the bedrock of my portfolio for sustainable income and growth, the Schwab US Dividend Equity ETF, SCHD. SCHD isn't just a random list of high-yield stocks. It tracks the Dow Jones US Dividend 100 Index, which is a collection of about 100 companies chosen for their rock-solid financial health. To even be considered, a company needs a record of at least 10 straight years of paying dividends. Then, it's screened for critical metrics like cash flow, debt levels, and dividend growth. This strict process is designed to weed out those potential yield traps from the start. With a dirt-cheap expense ratio of only 0.06% and a very solid dividend yield, currently around 3.8%, it's an incredible foundation for any serious dividend portfolio. Next, to fight inflation and lock in long-term growth, I use the iShares Core Dividend Growth ETF, DGRO. DGRO's game is a little different. It specifically targets companies that have a history of consistently growing their dividends for at least 5 years straight. This is absolutely essential for hedging against inflation. You don't want a static income stream, you want one that grows, so your purchasing power actually increases over time. DGRO's starting yield is more modest, currently around 2.2%, but remember, its main job is growth. The ETF is nicely diversified with almost 400 holdings and also has a super low expense ratio of 0.08%. Think of DGRO as the part of the engine that ensures your passive income is worth more tomorrow than it is today. Finally, to give my current income a nice boost without falling for a yield trap, I add a satellite position in the Amplify CWP Enhanced Dividend Income ETF, DIVO. DIVO is actively managed and does something really clever. It holds a portfolio of 2025 high-quality, dividend-paying stocks and then tactically sells covered calls on them. Think of it as generating income in 2 ways. You get the regular dividends, plus you get to rent out your stocks to generate extra cash from options premiums. This results in a much higher monthly income stream, with a current dividend yield in the 4.5% to 4.9% range. Because it's actively managed, its expense ratio is higher at 0.56%, which is precisely why I use it as a smaller, tactical holding to supplement the core of my portfolio, not replace it. It delivers that enhanced income without the wild risks of a 10% plus yield trap. Now, building a portfolio like this isn't a one-and-done deal. I'm constantly tracking these ETFs and navigating the market's twists and turns. If you want to follow along and see how this strategy actually performs throughout 2026, plus get my real-time updates on what I'm buying or selling, make sure you subscribe so you don't miss a thing. So, let's wrap it up. Instead of getting suckered into a high-yield trap, focus on building a dividend portfolio that's built to last. By combining a core of quality companies with an ETF like SCHD, adding a dividend growth engine like DGRO, and topping it off with an enhanced income strategy like DEVO, you create a system that works for the long run. It's a strategy that can give you income you can depend on, protect your buying power, and still deliver that all-important long-term growth. I'll see you in the next one.